Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Big day today because you are watching this video and maybe the Army-Navy game is happening right now. So I'll be watching the Army-Navy game. Of course, I'll be rooting for Navy.
Okay.
My alma mater went to the Naval Academy. Okay.
Go Navy, beat Army.
Go Navy, beat Army. Juana has been to, have you been to a Navy? You've been to Navy football games, but
Right.
we've never been to an Army-Navy game.
No, sir.
Okay.
Do you know why that is?
Why is that?
Because I'm a Las Vegas girl, and Las Vegas girls do not go to Pennsylvania in the winter.
Okay, it's actually in New England. Matter of fact, the
You're missing
Navy
the point.
players are in the dressing room where the Patriots.
Okay, so I'm going to
They
explain
get
this.
the Patriot.
I'm going to
dressing
re-explain
room.
this to you. I'm a Vegas girl. I don't do that kind of level of cold. That is in my contract. I don't do that.
In 1983, we played the Army-Navy game in the Rose Bowl. It was the coolest thing ever. It's the only time it's ever been played on the West Coast.
Yeah, I would have gone, but I was a kid.
Okay, now we're going to talk about real estate. We're going to talk about three things today that are sort of new information that came out. We'll talk about how this is going to affect real estate going forward.
Right.
Okay, one thing we're going to talk about the labor market and the jobs number just came out. Surprising data here. We talk about sentiment, consumer sentiment, because consumer sentiment drives behavior.
Mm-hmm.
And then finally, we're going to talk about interest rates because they've changed substantially. Like literally, the stuff that's changed in the last month is substantial changes. So we're going to talk about this going forward, okay? All right, so first, jobs report came out.
Mm-hmm.
Okay, here's the headline from the article. U.S. labor market defies slowdown forecast in broad strengthening. Payrolls rose nearly 200,000 in November, and unemployment fell. So the long-time unemployment rate, which was like literally the lowest it's ever been, actually fell some more.
Mm-hmm.
And then hourly earnings increased 0.4%, matching the biggest gain of the year. It's 0.4% in a month.
Mm-hmm.
So incomes are up. Of course, real estate prices are up, but this is sort of more than was forecast, right?
Right.
Okay. All right. So let's first start with the general macroeconomic thing. Interest rates have been raised substantially. The federal funds rate from 0 to like 5.5 or something. And now, without a change in fiscal policy, we're starting to see the economy continue to be strong even with inflation basically being choked off. So this is almost a perfect storm for the Fed, right? This is the panacea they were trying to create, this soft landing.
Right. Yeah. So, it's great that jobs are still strong. It's great that people are making more money. It's great that inflation is doing better. But the question is it really doing better, right? The Fed's going to meet next week, and they're going to be looking at a lot of this. They're going to be looking at the jobs report. They're going to be looking at people's spending, at people's debt, at all of this, and kind of try to divine a path forward from here. I guess my sentiment is that I don't think they're going to do anything. I think that there's going to be a robust discussion, and I think the robust discussion will be to maybe do one more hike. But I don't think they're going to do it. And I think that the argument for doing one more hike is the jobs report, is the people's income going up, and the concern that inflation is still with us and it's going to be pervasive, right? It's going to just not end anytime soon. And especially going into an election year and all of that, I think that there's going to be a lot of talk about that. But I think at the end of the day, cooler heads will prevail, and I don't think they're going to do anything. Those that think that the Fed's going to lower interest rates in the first quarter, I think that this most recent jobs report and the growth in income is most likely going to. Sorry, my Apple Watch went off, and I just forgot what I was going to say.
The Apple Watch started talking to you in the middle of the video.
But anyway, the point is, I don't think
the Fed dropping interest rates in the first quarter.
Right. I don't think that that's going to happen.
I don't either.
And there's still a lot of talk about the Fed dropping interest rates maybe in March. I still am holding out for the second quarter. I really don't think that they're going to do it until the second quarter, because I think that they're going to wait for the job numbers to kind of settle down after the holidays. I think they're going to wait to see what happens with inflation. So I think that they're really going to wait until the second quarter.
Here's the next quote from the article. Participation rate. The share of population that is working or looking for a job rose to 62.8%, driven by men. For those ages 25 to 54, participation rate was unchanged. A further increase in the labor supply could help alleviate wage gains. More people working and lower unemployment means higher GDP outlook generally, right? Because you have more production, you have more potential production, goods and services being produced.
But you also have potentially higher wages, which then you have money chasing fewer goods.
We'll talk about it in a second because I want to talk about that from a macro perspective, because potentially the opposite can happen. So let's talk about this. The jobs report is composed of two surveys, one of households and one of business. The household survey showed a 747,000 surge in employment, far offsetting a decrease in the prior month. Large number of people previously not in the labor force, as well as those previously unemployed, were able to find jobs. So we have this number, it was 7 million or whatever, 6 million jobs that were unfilled. And so those jobs are starting to be filled now. Mm-hmm. And so in theory, you could argue the other side of that, which is because we have more people entering the workforce, that's actually stopping this wage inflation from happening, because you don't have a smaller labor force chasing the same jobs. You have people coming in off the fence who said, hey, I think I'm going to get back into the labor force.
Right. But all of this also means that there will be fewer people to choose from an employer standpoint. So then you're going to have people job hopping, which people generally, when they job hop to a higher paying job.
That's possible. How does it affect real estate? Everyone's employed. People are coming out of the woodwork. There's still jobs available for them. Mm-hmm. Economy is kind of cranking forward. Mm-hmm. What does this mean for housing in general?
At worst, stability, or price increases, because if people have jobs, people have money to spend, people go out and buy homes or rent nicer homes or whatever. The bottom line of it is that at this point we've had interest rates at 7%, give or take, for over a year. So by the time we get into spring, it'll be a year and a half, and people do have relatively short-term memories. So I don't think that people are going to be still holding out for those 3% mortgage rates that their friends have. So I think people, like I said before, will go ahead and get on with life.
Let's talk about interest rates real quick. Here's another headline. We talked about this a couple days ago. Mortgage rates dropped close to 7%. Lower bond yields are helping buyers. Mm-hmm. Now the 10-year is absolutely tanked. It went from, I think it went just to 5%, and then it's now down to almost just under 4%. That 3% spread is the highest. Mm-hmm. Generally, the difference between the 10-year and the 10-year treasury and the 30-year fixed mortgage is usually 2 to 3% based on risk. There's still a lot of risk out there, so it's still around the 3%. Mm-hmm. They're talking, I mean, remember 6 weeks ago we were pushing 8%. People were dropping in the comments saying we're going to see 10% and it's never going to, it's going to be 1981 again, right? It's going to go back up to 10%. We're never going to go back. And here we are back down to 7%. And then I saw in a podcast, All In Pod, where Chamath basically said he thinks by 2025 we're looking at 2.5% federal funds rate. If that happens, we're going to have interest rates in the high 4s, low 5s again for 30-year mortgages in 2 years, basically.
Right. So what that means to you and I is, if you are on the fence about buying, that may give you incentive to go ahead and participate now and buy now, understanding that you have to kind of tough it out for a couple of years, give or take a few months, and then you'll be able to refinance at a far better rate. I don't have a crystal ball and say that that's going to be a certainty, but it's certainly a strong possibility.
This is my sentiment. If you buy now versus in 2 years, that what you'll have to pay for refi is much less than the price appreciation of the house. Mm-hmm. So buy the house, suck it up, and then in 2 years refi, capture the lower payment, but protect all the equity instead of waiting 2 years. I don't know what's going to happen to home prices. It could be the worst advice you possibly have heard. Home prices could drop. I just don't see that happening with supply and demand, which we're not really talking about in this video. But is what I think is, and one of the estimates I saw was, and it wasn't Fannie, but it was one of them, which was talking about 6.1% by the end of 2024. I think if we get back there, I think it's going to be, I think if we're in the 6.5s by the spring, it's super competitive again. I think we have a blow up spring. So I think that between the jobs report where everyone's working, this panacea of the housing crashers, all the foreclosures, they're not going to happen. They're never going to happen, right?
Right.
And then the second thing, interest rates are tanking. I think that's good for housing because I think some more houses will come on the market and then there'll be affordability will improve.
Right. So, we're looking at it just at one piece of this. So we do understand that credit card debts are high, that interest rates on credit cards, interest rates on cars are high. We do understand all that. We're just looking at one piece because this is what we do is real estate, but we do understand what's happening in the greater economy.
Okay, let's look at the third leg of this, consumer sentiment.
Yes.
Okay, this is from an article. U.S. consumer sentiment jumps as inflation concerns dissipate. So everyone's like, hey, inflation's going away, the economy's getting better, I feel really good, I'm going to go out and buy Cybertruck, right? Or the item. Well, here's the quote from the article, so from Bloomberg. U.S. consumer sentiment rebounded sharply in early December, topping all forecasts as households dialed back their year-ahead inflation expectations by the most in 22 years.
Wow.
So we have interest rates tanking, super strong job numbers, consumer sentiment off the chart. This could be a head fake, or this could be the beginning of the next multi-year expansion. And in multi-year expansions, housing does extremely well generally, right?
Right. And particularly since we've had so few transactions in the last, 14 months, there is a lot of pent-up demand, which kind of goes back to what I said about inflation. I'm less than convinced that it's under control.
Okay, I agree. I think it's going to take more. Like, I like data. I don't like making decisions based on just making stuff up or gut feeling. I like to look at the data. That's why we talk about data on the show. I like to see more data, right? I'm not completely convinced, but looking at this tells me that there's more upside than downside, meaning we had 3% interest rates 2 years ago. And now we have 8% rates, but home prices are higher than they were 2 years ago.
Right.
Yeah. So you were told 18 months ago by a lot of people home prices would be 40 to 50% less by now. And they're higher. So I'm a little hesitant to those people who the spring of 2022 panic sold strictly based on the coming collapse of housing. And we still have people who say, no, it's next year, Todd. Next year. Well, based on what?
Okay, well, there was panic sales starting with about 2020, but that's another story.
The panic sales started in 2020,
yeah.
You think?
Yeah.
Okay. All the leading factors to me, and this is the slow time of year. We still have people that reach out to us almost on a daily basis, asking questions about buying, asking questions about selling. And, the bottom line is the best time to buy or sell is when it's best for you, regardless of what's happening. But, if you're trying to make decisions, should I wait 2 years to buy when interest rates drop? That's a possibility. The risk is that the house you could get today for $400,000 is going to be in 2 years $450,000. And yes, you'll originate that loan at a lower rate potentially, but then also you could have just bought the house at $400,000 and refied it in 2 years. You'd have 2 years of a little higher payment, but you would be paying off down the mortgage and then you would just refi. And you would be in a better position than buying it in 2 years because let's say your interest rates in 2 years is 5%. So 5% of $400,000 or 5% of $450,000.
Right. So the bottom line,
your payment would be more.
Right. So the bottom line is, while you can reduce your interest rate, you can't reduce your purchase price.
Yeah, and without coming up with a ton of cash. So,
Well, that doesn't
and,
reduce it. It's still part of the purchase price.
and don't accuse us of saying that home prices are just going to go up. We're just pointing out a thing. If I thought for sure home prices were going to fall, I still wouldn't sell any rentals because we still collect rent from the rentals.
Right.
I'd probably just go buy some more. The other thing too is, this is kind of a last thing. The number I heard was 5.7 or 5.8 trillion in money markets.
Right.
That money's got to go somewhere.
Right. So as the yield in the money market goes down, that money is going to come out of those money markets. Is going to hit the stock market because that's what people do. Obviously, some people will also choose to put that money in real estate and in other investment vehicles. But the point is that the money out of the money markets will come out, and it will be put to work in other investments, including real estate.
It's in there now because there's a lot of risk, and you can get 5.5%.
There's no risk in the money markets.
No. I'm saying there's a lot of risk elsewhere.
Right.
But there's no risk in money markets. So if I give you the opportunity of here's 5.2% risk free, or you may get 10%, you may lose 10%, I would take the plus 5%.
Mm-hmm. Sure.
But then if I was told, okay, you're going to get 3% from this money market, but the stock market's going up at 12% a year and housing's going up at 5 or 6% a year, plus rents you would collect, you might make a different decision.
Right.
And then remember, the difference there is that real estate is still safer because it's like a dividend stock. You're going to collect your rents whether or not the prices go up. Whereas in a stock, you're generally only hoping for the appreciation.
Right. The bottom line is we are not giving you investment advice.
No, we're just throwing out stuff.
We're just having a conversation. So please do not take this as investment advice.
No.
What did you think? What's your strategy for 2024? Are you taking the money out of the money market and doing something else with it? If you are, what are you doing with it? Are you putting it all in the stock market? Are you buying real estate? Are you doing some combination thereof? Or are you just letting it ride in the money market? We're just curious what you guys are doing out there. Please feel free to share your real estate related comments. We appreciate them. Please remember to like the video, subscribe. We're so close to 10,000. We're so close.
Yeah.
So please subscribe, hit the notification bell, and we'll see you on the next video. Bye.
Beat Army.
Go Navy.